You look at your portfolio, same old story, right? I mean, your index funds are bouncing around like a heart monitor. Your savings account is throwing you like a few pennies a month just to insult you. And your bonds? Please, you're losing money to inflation every single second you hold those things. Most people think the only way out of this trap is to find the next Nvidia, to scour Reddit for a stock that's going to go up 4,000%. They think wealth is about picking the right horse at the track. But the math proves it's actually about owning the racetrack itself. It's about becoming the bank. Look, I'm Heisenbank. I spend way too much time looking at spreadsheets and dissecting financial structures, so you don't have to. And today, I need to talk to you about the biggest, quietest wealth transfer happening in the markets right now. It's a $1.7 trillion market. Trillion with a T. And you probably don't have a single dime in it. I'm talking about private credit. By the end of this video, you're going to see exactly why the ultra-wealthy completely ignore the shiny toys retail investors obsess over. You'll understand the brutal, undeniable math behind acting like a financial institution instead of a gambler. This changes your entire perspective on risk. It changes how you look at every single dollar you invest from this day forward. Because, we aren't playing their game anymore. The death of the middleman. So what exactly happened? Why is private credit suddenly eating Wall Street alive? You have to go back to 2008, the financial crisis. Banks behaved badly, the world economy nearly detonated, and regulators came down on the big banks with a hammer. They passed all these laws, making it incredibly expensive and, frankly, annoying for regular banks to lend money to mid-sized businesses. Banks got scared. They became heavily regulated utilities. But guess what? Companies still need money. If a software company in Ohio wants to buy a competitor for $200 million, they can't just walk into a Chase branch and ask the teller for a loan. And doing an IPO or issuing public junk bonds, it's an absolute nightmare of red tape and public scrutiny. I mean, who wants the SEC crawling all over their books if they can avoid it? Enter private credit. Instead of a bank, a private fund steps in. They say, hey, we'll give you the $200 million, but we want 11% interest, and we want to be first in line if you go bankrupt. The company agrees because it's fast, it's quiet, it's certain. The middleman is dead. The bank is cut out. The private credit fund just replaced JP Morgan, and they're keeping all the yield for themselves. And here's the kicker. For decades, this was a velvet rope club. You had to have $10 million minimum just to get the pitch deck from an alternative asset manager. But that wall is finally cracking. The brutal math of the senior secured position. Let's get into the numbers, because feelings lie, but the math doesn't. This is the strongest reason the smart money parks billions here. It's called the capital structure. Imagine a company as a giant layered cake. At the very bottom, you have the equity, the common stock. This is what you and I usually buy on our brokerage apps. Now, listen to me closely. Equity is the most dangerous place to be. If the company goes bankrupt, the equity goes to zero. You get entirely wiped out. You're the absolute last person to get paid. You hold all the risk. But at the very top of that cake, that is the senior secured debt. This is where private credit lives. Senior means they get paid first, before anyone else. Secured means the loan is backed by the actual assets of the company, the real estate, the software patents, the inventory. Let's run a scenario. Let's say a company takes a $100 million loan from a private credit fund. The company hits a wall. The economy tanks. They default. What happens? The equity investors lose their shirts. The public stock goes to zero. But the private credit fund? They just take the keys to the company. They seize the assets. Historically, the recovery rate on senior secured private credit is around 70 to 80 cents on the dollar, even in a worst-case bankruptcy. And if they don't go bankrupt, the fund is pulling in 10 to 12% a year in cash flow. Think about that math. If you invest $5,000 a month at a 10% yield over 20 years, you aren't just hoping a stock chart goes up. You are mathematically compounding your way to over $3.8 million. Pure math. No predicting the future required. You're taking less risk than the stock market, but you're getting equity-like returns. It almost feels illegal. It's an asymmetrical bet. Look, if you're tired of playing the victim to Wall Street's casino and you want to actually understand how the financial machine works, hit that subscribe button. We don't do hype here. We do the math. Welcome to the right side of the trade. The floating rate phenomenon. All right, let's talk about the silent killer of wealth. Inflation. You buy a standard government bond paying 4%. Suddenly, inflation spikes to 6%. Congratulations, you're now losing 2% of your purchasing power every single year. You're slowly bleeding to death and calling it a safe investment. But private credit has a secret weapon. Almost all private credit loans are floating rate. This means the interest rate on the loan is tied to a benchmark. When the Federal Reserve panics and hikes interest rates to fight inflation, regular bonds crash in value. But private credit, their loans automatically adjust. If base rates go up by 2%, the private credit fund just charges the borrower 2% more, automatically. Your yield goes up exactly when you need it to. You're completely protected from the central banks messing with the money supply. You essentially turn inflation from a parasite into a tailwind. Let that sink in. When the rest of the market is panicking about rate hikes, private credit managers are literally popping champagne because their cash flow just increased overnight without them doing a single thing. The psychology of boring. So why don't people talk about this at dinner parties? Because it's boring. Human beings are psychologically wired to crave the dopamine hit of a lottery ticket. We want to buy a meme coin at 3 cents and sell it at $1. We want the thrill. Stock markets are designed to give you that thrill. They flash red and green all day. Every tick triggers a tiny chemical reaction in your brain. Private credit is the opposite. You hand over your money, and then nothing happens. You just get a fat dividend check every quarter. There's no daily price chart to obsess over. The loans are generally illiquid. You can't panic sell them on a Tuesday afternoon because you read a scary headline on Twitter. And that illiquidity, that is actually a superpower. Wall Street calls it the illiquidity premium. Because you are willing to lock your money up for a few years, you get paid a higher interest rate. But psychologically, it protects you from yourself. The average retail investor loses a massive chunk of their lifetime wealth strictly through behavioral errors. They buy high when everyone is euphoric, and they sell low when the news tells them the sky is falling. Private credit strips your emotions out of the equation. You literally cannot panic sell. You are forced to act like a rational, long-term financial institution. You're forced to be patient. And in finance, patience is highly compensated. The retail access point. Okay, so I know what you're thinking. Heisenbunk, this sounds great, but I don't have $10 million laying around to give to Apollo or Blackstone. What am I supposed to do with this information? Well, the gates are opening. Wall Street realized there are trillions of dollars sitting in retail retirement accounts, and they want a piece of it. So they created structures for normal people to get in. The most common one is called a BDC, a business development company. You can buy them right on your standard brokerage app, just like a stock. Heirs Capital, Owl Rock, Main Street Capital, these are publicly traded companies that do exactly what we just talked about. They pool money, they make senior secured floating rate loans to mid-market companies, and by law, they have to distribute at least 90% of their taxable income back to investors as dividends. Some of these BDCs are throwing off 9, 10, even 11% dividend yields right now. But, and this is a massive but, you have to know what you're doing. Not all BDCs are created equal. Some of them make incredibly risky loans to garbage companies just to juice their yield. When a recession hits, those companies will default and the BDC's stock price will collapse. You have to look under the hood. You have to look at what percentage of their portfolio is actual senior secured debt. You have to look at their non-accrual rate, which is just a fancy way of saying how many of their borrowers have stopped paying. You have to do the work. But the point is, the asset class is no longer hidden behind a country club wall. You can access the exact same yield as the billionaires. The new paradigm. We're living in a weird economic era. The old rules of a 60-40 portfolio, 60% stocks, 40% bonds, are broken. They rely on a world of stable inflation and predictable growth that frankly doesn't exist anymore. You can't blindly hand your money to the public markets and expect to effortlessly glide into a wealthy retirement. You have to stop thinking like a consumer of financial products. You have to start thinking like the house. When you lend money to a profitable business, taking a senior secured claim on their assets and charging them a floating interest rate, you are no longer crossing your fingers and hoping a stock chart goes up. You're injecting yourself into the absolute core of the economy. You're positioning yourself where the math is stacked heavily in your favor. It isn't flashy. It isn't going to make you a millionaire overnight, but it will build a fortress around your wealth that is incredibly difficult to tear down. As J. Paul Getty once said, if you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. Stop buying the equity of companies hoping they succeed. Start owning the debt that forces them to pay you regardless. I am Heisenbank. See you on the next one.